Generally, there are two methods applicable for the impairment of assets, and this is applicable for generally all the assets except for the derivative instruments, because for the derivatives we have separate standards, separate valuation methodology. So this is generally applicable for property, plant and equipment, that kind of assets, or the inventory. But the land, goodwill and derivative products, which is the financial instruments, they do not come under the ambit of this. Of course, land cannot be depreciated anyway. Goodwill cannot be depreciated anyway, right? They are generally impaired. But we need to understand what the testing available for land and goodwill. But when it comes to impairment of the assets, we need to do a couple of tests. And that is, do we have any sign that the asset has been depreciated? And how do we know that? When we think that the carrying value of asset is less than the recoverable amount, right? Can someone tell me the difference between the carrying value and recoverable amount first?
Carrying value is usually the book value, whereas the recoverable value is the amount which we'll get when we sell it or dispose of the asset, less the cost included in disposal.
So that is recoverable, right?
Yes.
Okay. Good. Yeah, that's a good one. And there are other ways you can also recover the value from any asset. That could be, so what you said is correct. In addition to that, I would add, you can also recover the value from an asset when you receive rental income, right?
Value in use?
Net cash inflow.
Yeah, value in use. So recoverable amount, recoverable amount also have different component, right? You can sell it or you can use. That is another way to recover the value, right? The future economic benefit. Because one of the definition, actually the most popular definition of asset is what? Asset gives you the benefit in the future. It has the future economic value, right? And how would you ascertain the future economic value? There could be two ways. Either just immediately sell off, right? Something like if you consider that example, you know the golden hen, it used to give one golden egg every day, right? So that is a way to say that, okay, you can use that, you can keep that hen, use the asset, or keep that for future benefit. So getting one egg every day. Or you can sell that hen. In one go, you might get $1 million. But it doesn't mean that in either way, it is not a recoverable amount. Agree? So you can keep the hen here and use it, get the future economic benefit, or you can sell the hen. Either way, you are going to get recoverable amount. Of course, you're right. You had mentioned earlier that whether you sell or you use, there will be some transaction cost, maybe to protect the hen, to deliver it to in the town or city. There will be some transport cost, administrative cost, legal cost, maybe all those. You need to maybe get a vet doctor, all those kind of things. But if you keep the hen, then you have to feed it on a daily basis. There will be some deduction for that as well. So you need to find out how much you are going to make as in terms of dollar or euro or whatever the currency you use. That value, let's call it A. and then when you sell it, how much you are going to get after all the adjustment, that is B. So that is a realized value, there is the value in use, A and B, and you have to then check which one is greater. Is A greater than B? Whatever is bigger number, that will be your recoverable amount. Now the question is, if your recoverable amount, this is smaller than carrying value, there is a outright impairment. So that is essentially the concept of that's the definition for judging how to find out the impairment, and if the impairment exists, then we can do the testing. Now we'll go into the details and deep dive with some nitty-gritty. The following indicators shall be considered for impairment. Internal source, what could be obsolescence or physical damage of an asset. So if you see that the plant that you had bought, it is physically damaged, not able to manufacture the goods, then on the face of it, it is impaired. Current or future adverse changes. What about market share? Right? Suppose that Nokia was taken over by Microsoft, and Microsoft realized that Nokia market share is reducing day by day. That is an indication of the impairment. Next comes the economic performance. Eventually, the brand or the requirement of that product in the market is declining. So that is another sign of impairment. So this kind of obvious marketing signs should also be considered by accountant. It is not only about the cost or present value or sales value, etc., that we should look at. As an accountant, we also need to consider the market of the product in order to ascertain whether there is any impairment. External sources, significant decline. Okay, so all are the in the same bucket. So significant decline in the assets market value, changes in the technological, market, economic, or legal environment, etc. So whenever you see that there is a decline in revenue or profitability, market share, or overall functions, the plant that you had was able to manufacture some 100,000 shoes or product every year, and it is not able to manufacture as many, there is an obvious decline in the value and its performance. So all these factors are the one which will indicate the impairment of the asset. What if you have a subsidiary? Because typically, when as a parent company, you buy a subsidiary, what happens typically when you paid, suppose, 100 million for a subsidiary, and the net asset of that was only 80 million. The gap of 20 million so the gap of 20 million is considered as goodwill. The treatment of that is, let's jump to the next page. Whenever you see there is any impairment in goodwill or a subsidiary, first we remove goodwill, and if any amount is remaining, then we proportionately allocate that. the impairment. So how do we know that there is a that there is a impairment in the value of subsidiary? That is indicated by reduction in the dividend. So your dividend is declining. You used to pay $1. Now from $1 it goes down to 0.8, then goes down to 0.5, etc., which means there is an impairment in the value of the subsidiary.
I have a question.
Sure.
What if the operating profits are increasing? Like suppose operating profits have rise, but the dividend has been reduced. That doesn't necessarily mean that there's an impairment.
True. So you have to weigh all the indicators in a holistic manner. So this is one for the dividend. The second could be market share of the subsidiary as well. But your point is right. But that is generally, that does not happen. So that's why it has been considered as a rule that if the dividend declines, it could be an indication. So that's why the word is, it is indication of impairment, but not necessarily the impairment. That means you need to check the further. If you see a decline in dividend, or when you see that dividend exceeds the total comprehensive income. See,
I will ask more
in your question, in your scenario, dividend is declining, going down, but operating profit is going up, which is a good sign. That could mean that you have more profitable projects to invest your dividend. So you're not paying as much dividend, but your operating profit is going up, which is a good sign. But if your dividend is going down, sorry, can you, those who are not speaking, mute? All right, back. So we have to capture the holistic picture, dividend, operating income, market share of the subsidiary, everything in conjunction to decide whether the value is impairing or not. So this will be something like the entire analysis of the ratios of the financial, liquidity, gearing ratio, etc. But without going into that detail, we can also find out from a couple of indications like dividend, market shares, operating profit, entire profitability of the subsidiary. These are some of the general indicators. Of course, there could be some conflicting indicators as well. So that's why we use the word indication, right? But good observation. So if the dividend is declining, imagine the operating profit is also declining year on year, or new competitors have entered your subsidiary market. In the market of the subsidiary, you see some new competitors entering gradually. That will be indication of impairment as well. So on, you have to continue checking. When do you do this? Generally, we don't depreciate, right? Land or goodwill, something like this. But on the same time, we have some discipline around this. Once in a year, every end of the year, when we start preparing the financial statement, we need to check for the impairment. Okay, so that's the timing. Timing to check for impairment annual. Okay, now once we know that there is any impairment, as we discussed, what are the steps to take? So first strike out all the goodwill, then net asset to be reduced in proportion. And what happens when we do that? Any impairment that is noted, it will reduce your P&L. So the parent will have a debit entry in P&L. Or if it is not the parent, it is the main or if it is the main company itself, regardless of the situation, if there is any impairment, that will be treated like an expense in the profit and loss statement that year. So here we are back with the formula and the rules. The recoverable amount is determined for an individual asset unless the asset does not generate cash inflow that are largely independent of those from other groups or asset. So in a simple way, the asset fair value less the cost of disposal is higher than the carrying amount. So if the asset's fair value less cost of disposal is higher than the carrying value, or assets value in use basically is higher than the carrying value, in that case there is no impairment. Otherwise there is an impairment and note an expense in the profit and loss statement. And it could be not only for the inventory, not only for the property, plant and equipment, it can also be for your subsidiary that you have owned. And generally, whenever you pay an extra amount, in our previous example, we said we paid 100 million for a subsidiary which asset was only 80 million. So the difference of 20 million is the goodwill. And that goodwill will be always on your radar for the annual test of impairment. And you need to continue watching the two signs of impairment. What were they? Internal signs and external signs of impairments. And it's not only for the subsidiary, it also for the PP&E, property, plant and equipment. Any question, doubt? Okay, moving on. Some more rules. Fair value less cost of disposal. So here what we are talking about is selling price, right? So when we decide to sell an asset at arm's length transactions, normally we call it arm's length transactions. The reason is arm's length is considered to be a fair price, and it is a kind of a proverbial way to say that it is a fair price, because when someone is doing the dealing at arm's length, right, at some distance, that means there's nothing to hide. There's no secrecy, right? It is a fair market value that two willing and informed parties are going into, and hence it is a fair price. So whenever you sell something, it should be a fair price, informed parties, and just like you see in any agreement, and any cost of disposal that should be subtracted to arrive at the final dollar value, which is, say, A. Then if there's no sale agreement, basically there are some challenges also discussed here. If you don't see any sale agreement or any relative price to arrive at the fair value, then you have to determine on the basis of some other measurements. Like if there's no active market for the asset, fair value less cost to sell is determined based on the best information available to reflect the amount that an entity could obtain. Imagine that there is some any airlines is trying to sell it Boeing 380, okay, and they don't find any recent transactions for that. What to do? No one has bought or sold Boeing since pandemic hit. So they will try to look for similar plane which was sold in last 12 months, and apply some discount on that, or they can just look at any other smaller plane, and based on 30-seater or 50-seater, they will take a proportionate valuation and determine what would be the most fair value in the market. So those kind of estimates or the fair value accounting methods are also permitted to determine the fair value less cost of disposal. So you can take the inspiration from the valuation methodology. So value in use, we have talked about the fair value so far. Fair value minus cost. Now let's talk about value in use, how to determine that. So I gave an example briefly about the rental property earlier, right? Suppose a situation whereby, let me introduce a blank PPT to explain this better. Imagine you had a carrying value of a building which has 100 flats, okay, residential flats, by the way. Now it is considered to be worth of 100, say, million, okay, any currency unit, doesn't matter. Somebody posted a doubt. Auditor said that how sure you are the value might have been depreciated or impaired. Now we need to do a testing. The test is, this is my carrying value, right? One thing. Now I know fair value of this because based on another real estate businessman who sold 100 flats or some 10 flats, the fair value of this 100 flat would be somewhere around 90 million USD. Okay, but don't make any decision, hold on. So this is fair value, 90 million or any currency unit, because we have started with currency unit. Then your auditors also suggested, or maybe your accountant suggested, that why don't we value using the rental? So what we estimate that this 100 flat will give us 100 or maybe 1 million. Let's make it 2 million, actually 2 million for next 80 years. Okay, so 2 million for 80 years. We have a cost of capital, and all this would be relevant when you are making any calculation under IFRS or any professional exam paper such as ACCA, CFA, CPA, etc. These are the nuances that you need to deal with. Okay, so the cost of capital is 10%. Now you need to take the present value of all the cash flow, because that's the meaning of the value in use. So value in use, year 1, 2, 3, 4, 5, 6. Just imagine that I have written it 80 times. Okay, 80 times. So the total we have to take. Now I know the rent will be, and just consider that the rent is not increasing, there's no inflation. Okay, so 2 million per year. Applying 10% discount per year, the worth is, say, X, Y, Z. We can do the mathematics later on, but just understand the process. X, Y, Z, blah, blah. And at the end of 80 years, if we take all the present value, like the value of rent 1 year from now, 2 years from now, 3 years from now, if we take the present value, something called net present value as well, then the worth is 110 million. Okay, this 110 million is what? Value in use, right? That's what we started to calculate, value in use. Now we know that carrying value is 100 million, fair value less deductions is 90 million. If you have to decide between the two, of course, there is an impairment, but let's wait. And also check for value in use. Based on cash flow, the rental, applying the net present value, the cost of capital, everything. To make it more complicated, we could have applied the inflation, then the rent will start to gradually go up. All those things we can do, but the net value in use based on MPV method, it comes to be 110 million currency unit. Now, choosing the higher of the two, because if I have, as I gave you example earlier, a hen that gives the gold, which option should I choose? I should choose the one which will give me more benefit, more economic benefit basically. If I sell, I might not get as much gold, but if I keep it and still I have to feed the hen, I might get more golden eggs. So we have to consider between the fair value and value in use. Whatever be the higher, that will be my choice, right? Why would I go for the lower value? So we take normally higher value when these two situations comes. So I will consider this value. I will use all my 100 flats to earn rental income in the future. Okay. Of course, there could be some risk, there could be earthquake and all those factors. We have a method to discount for that as well when we calculate the NPV. So we can factor that in the risk element. But for now, let's assume that there is no earthquake, there is no inflation. So value in use is 110 million. So that's my value to compare against the carrying value. So I still see that carrying value is smaller than value in use, hence no impairment. Okay. Now let's reverse the situation a little bit. Let me go to the previous page. If all my rent collection was only 1 million, okay, let me delete this, 1 million, and all of this also becomes 1 each. So 1 million every year for 80 years, how much it would be? Something like 65 million only. Let's change the value here. So the rent value in use has become 65 million currency unit, and fair value less deduction is 90 million. The bigger of the two is 90 million, and hence when I compare the carrying value versus value in use, I find carrying value is higher than the value in use. By how much? 100 minus 65. So there is a 35 million currency unit worth of impairment. This impairment will have such journal entries. Credit, investment in property, or maybe real estate. Debit, recognize an expense. Impairment in comprehensive income. Comprehensive income. Just a language for IFRS to say P&L. Okay. So credit 35 million, debit 35 million. Done. This is how we need to handle this step. Recognizing an impairment loss, some key points. That reduction is an impairment loss. An impairment loss shall be recognized immediately in the profit and loss. We have discussed already. Impairment loss of a revalued shared asset shall be treated as a revaluation decrease in accordance with other standards. Interesting. So some of the way to understand what happens subsequent to the revaluation. Imagine there is a asset which was impaired earlier in say 2018, but your accountant in 2020 said that, you know what, there is an appreciation in the market and this plant and the equipment should be increased in should be revalued, and we need to increase the value of that asset. Then I would ask that, okay, how much was the impairment when we did it in 2018? And accountant said that the impairment we had recognized was 10 million. Okay, great. How much do you propose the increase in value is? Answer was 20 million. Okay. So if 20 million is increase in value subsequent to the impairment of 10 million, how much should we recognize in the P&L and how much should go into the revaluation reserve? Anyone? Am I clear with the question?
10.
If you have made an impairment loss and recognize that in 2018 as to the extent of $10 million, and market changes, the demand of your product came into fashion again, and by all means the value of the plant or the equipment should be increased, and the proposal is that the value should increase to the extent of 20 million. What will be your treatment in such case? Would you put all 20 million as the appreciation in the P&L? Would you put something in the revaluation reserve, or would you just ignore this number? What would be your action?
The last year's has to be reversed.
Okay.
And this year's 10 million has to be recorded as revaluation surplus.
All right. On the first statement, the last year, or say 2018 number, need to be reversed, right? How would we reverse this? You're going right, but I just want to get more detail. How would you reverse that?
We would increase the asset price and last year's P&L also.
No, and not quite like that. But you're going in the right direction. Let's make a little tweak. Okay.
Will this come under OCI?
This will be part of revaluation reserve and OCI. You're right. So that's why I'm see the revaluation number here. So when you put the numbers in revaluation reserve, yeah, that becomes part of OCI. Because remember, the OCI is combination of various number which does not go into the P&L, like your foreign exchange movements, yeah, any gain or loss in terms of the pension defined benefit plan of employers, various appreciation of the derivative instruments, those which does not go into the P&L if they are not the trading products, they are recognized in the OCI. So there are two, and there are some insurance related gain and loss that also goes into OCI. So OCI has like 5-6 different types of numbers which is adjusted there. And when you settle the product, when you sell the product in the market, then it is kind of reversed from OCI and put back into the where? P&L. Okay, so your P&L has two parts essentially. IFRS allows you to have just to clarify it for everyone, IFRS allows you to have a comprehensive income statement, right? Statement of comprehensive income. So you can have two ways. Either you can have you can provide everything here without making a header for OCI, but then you have to put all the details of OCI in the disclosure notes. Following me? The second way is that you have this structure. Statement of comprehensive income, and then in the same statement, basically same page, you also have other comprehensive income. There, what will go? FX gain loss, defined benefits impact, derivative instruments and their movement, so you can frame the P&L in two ways under IFRS. Does that make sense? All right, back to our original question. So if we have 10 million and 20 million, how would we treat that? Recapping our scenario quickly. So a plant that you had was impaired in 2018 and loss recognized was $10 million currency units, or let's say USD. One. Secondly, come 2020, value increased by 20 million as per the valuation experts. Now you have to think what to do in P&L, balance sheet, and what should be debited, what should be credited. These are the questions. Okay. And also reserves, how to treat the reserves. These are some of the questions. So the rule says if you have made the impairment in previous years, any year in the previous, you can credit in P&L, in profit and loss, only to the extent of impairment in the past, which means credit in P&L will be only USD 10 million, because that's what you had done in 2018. And you are, because of this information coming in 2020, you are not allowed to make a change in the previous year financial statement. That's another thing to clarify. So whatever you do, you have to do everything in current year. Okay, so one entry made. Now we know that overall the value increase in the asset is 20 million. Okay, so let's have a debit for a minute just to keep the record clean. Debit gain in value 20 million. Okay, now 10 million is missing between debit and credit. So another credit in reval reserve, you can plug that under OCI as 10 million USD. So 10 million, 10 million and 20 million debited. But you can't go beyond 10 million because this is what you had impaired in the past. If there was no impairment in the past, everything would be in devaluation reserve, because you can't recognize such revaluation in the property, plant and equipment and such assets directly into the P&L. Okay, so it will go into the devaluation reserve if there was no impairment. And when you sell in the future, now come 2025, you sold that plant, and then all the revaluation reserve will move from OCI to P&L. Is this clear to everyone?
Yep.
All right, great. So let me check some other important point, if any. I have already discussed reversing an impairment loss. Okay. For a cash generating unit, reversing an impairment loss for an individual assets. The increased carrying amount of an asset other than goodwill shall not exceed the carrying amount that would have been determined had no impairment. Yeah, so the same point that we discussed. Reversing an impairment loss for a cash generating unit. Another point, good point to make is if all of the value of the asset is impaired, that is reversed into the P&L 100%, and we stop to recognize the asset if everything is impaired. Allocation of the reversal of the impairment. The carrying amount of an asset shall not be increased above the lower of recoverable amount and the carrying amount that would have been determined after the impairment. So we have discussed and covered that one already. So let's do quickly a numerical. So this is to clarify one of the point I discussed earlier, but this will just consolidate the idea how to allocate any loss. So imagine a cash generating unit has following the data whereby 55 million USD has been recognized as loss, as an impairment loss in 2020. How would you allocate the loss and how the new balance sheet will look like? Okay, so the situation is like this. There is a parent and subsidiary. Parent had paid, I believe, 100 million because there is a goodwill of 30 million. For the subsidiaries net assets, which was only worth 70 million. How much is goodwill? 30 million, right? So goodwill was 30 million. So this is implicit in the question, but I just wanted to highlight this structure for you to have a clear understanding of what is going on. So that 30 million is there in the goodwill, and this is the book of which company? Subsidiary. So it's the subsidiary assets which is recognized in the balance sheet of parent. So this is the book of subsidiary which is reflecting goodwill, property and plant. Everything comes to be 180. Now we have to recognize 55 million USD loss as impairment loss. There is an impairment loss of 55 million. First step, what I said, you need to remove goodwill. So minus goodwill 30 million. Now how much left? 55 minus 30, 25 million, right? That 25 million will be allocated in right proportion between the remaining assets. And we have to allocate that loss in a proportionate manner between the remaining assets, because the overall impairment is applicable for all the assets, right, of any company. Because we unless we have more specific information, it might be given in the question paper. I might say that, you know what, everyone, property remains 60 million only. Then what would you do? You allocate all the losses to plant and equipment. So unless there is any other information given, please allocate any impairment loss in the same proportion as the value of asset. What does that mean? So 25 million to be allocated like this.
I have a question.
Sure.
What if the question states that only property has been impaired? Then we don't reduce goodwill, right? We will deduct the amount straight from property.
True.
Okay.
Yeah, so they need to tell us any overriding information, because generally the rule of thumb is that unless someone give additional information, first you need to clean entire goodwill, because this is the goodwill is actually the assumptions that any extra dollar I'm paying, you know, when you go to buy any expensive pen, right, it hardly write like a $1 pen. But sometimes they charge $200 for what? $199 is for the goodwill or the brand. So any loss that happens, we assume that it is going to wipe out the goodwill. So, but yeah, you're right. If someone says that, okay, all the loss was done on the property because maybe property was burnt overnight, then property will be removed from the balance sheet. So going by the rule of proportion, 25 million will be allocated like this. 60 by 150, right? 60 plus 90, 150. 60 divided by 150 times 25. And second allocation will be 90 by 150 times 25. Okay. So that should be how much? 10 million. And this should be 15 million. So the loss allocation to the properties will be 60 minus 10, 90 minus 15. So this becomes 0, this becomes 50, and plant and equipment becomes 90 minus 15. How much? 75. So 50 plus 75, 125 here, but goodwill is gone. This is how we allocate. Any question before I move to other statement, other standards?
No.
Yeah.
Cool.
Sorry, I joined a little bit late. So I just want to understand why you have removed Goodwill. I'm not very clear on that one. That is, you've allocated the losses to other property, sorry, to other assets, but you have removed Goodwill. So if you can just clarify for me that what the reason that you have removed.
Okay. So the reason I removed goodwill first is that in case any parent has acquired the subsidiary at a premium price, and generally it happens, right? When Microsoft is buying Nokia, they will give some couple of 100 million extra, and that is called goodwill. Any loss or any impairment which is observed at the subsidiary, basically, first assumption is that goodwill is impaired. So that's why before we make any adjustment to the net asset, because asset still is producing something, but goodwill is something that was just kind of given a fictitious value at the start. So it is rule of thumb that in case of any impairment in the value of the subsidiary or any asset that we acquire, we first remove goodwill before we reduce the value of any other tangible assets. Because tangible, when the assets are tangible, they always have more value, some tangible values, right? Property, plant, equipment. It is the goodwill which is always in our mind, isn't it? Can we touch goodwill? Can we show to somebody that, hey, here is my goodwill? No, it is always in the mind. So the IFRS suggests that whenever you observe any impairment in the asset, first reduce it from the goodwill, and then if further impairment numbers remain, then apply them proportionately in the tangible assets. Make sense?
Oh, get a point. No, now I'm clear now. Thank you.
Okay. So next I'm going to talk about intangible asset. Let me share the PPT. Hope you can see this now. It's one of the great big standard as well, IS 38, but we'll make it simple and quick. How do we get any intangible assets? There are two ways, right? Internally and externally. We are quite familiar with external ones. And what are they? Patents, copyrights, license, isn't it? Similarly, we generate some internally as well, softwares, vaccines, I'm sure no one needs any introduction to how vaccines can be internally generated. Intangible asset, right? Now, corona vaccines are also in the market. So there are two types of intangible assets. Externally acquired, quite easy to quantify, quite easy to put in the balance sheet and recognize, because what we do, I go to the market and I buy a software which can see the future, right? I can sell that output or predictions to almost every 7 billion people in the world, and I can get future economic benefit. So if I can get a future economic benefit and it can be continuous and it is in my control and it has a precisely defined market, it is commerciable, right? It is it has a market, then I'm sure that it can generate economic benefit. And since it is a software, it is not a tangible asset, it is a software, I can put this under intangible asset and I can recognize that as a intangible asset. Of course, it will be tested for the impairment, and that's why I just covered impairment at the start. It will be tested regularly for any impairment on once in a year. And in case of any impairment, we know how to treat them now. Now, how do we recognize the value? So I bought it from Google, this software which can see the future, for $100 billion. I'm just making up the number. I haven't done anything like this. So $100 billion. Then some professional fees, legal fees, tax, etc. were also expensed. So all of them 10 million, 10 million, 10 million. I will add everything. So it becomes $130 billion. This is the price I paid for that software to acquire. So any duties, non-refundable taxes, any trade discount or rebate, everything will be considered before we put a number on the worth of intangible asset. Okay. And what is this trade discount or rebate? It is only saying that if I bought this software from Google and Google said that, hey, I will give you $10 billion discount at the start, then I have to adjust that as well. And that's natural, right? When I'm putting the price as 100 billion, I could have just made it 90 billion. So whatever I pay and other unavoidable cost, professional fees, etc., everything will be added to arrive at the intangible assets value when it is externally acquired. It is as simple as that. But there are some conditions. If you pay for acquisition of an organization and you are sure that there are 1, 2, 3 different intangible assets, but somehow you're not able to distinguish them. Distinguish them means you can't separate one asset from another one, right? Like in previous situation, here I was able to clearly distinguish the software which can see the future. But if I buy, suppose I buy Google itself tomorrow, let's make some crazy predictions. If I buy Google tomorrow and I'm not able to distinguish different kind of software that the business unit it has, and there's no clear separation between one unit to another unit. But since I have paid a lot of many $1 billion, I know there is some extra money which has been paid for the intangible assets, but I'm not able to distinguish Google's alphabet between Google search engine or various other revenue generating unit. I'm not able to distinguish between the different softwares it has, right? What to do? Or I'm not able to quantify the precise value of YouTube, which it owns, right? In that case, I have to just put all additional money or intangible value under one category called goodwill. Are you still with me? Little detailed and technical here. So when you are not able to distinguish or distinctly identify the intangible asset, right, during the acquisition, then don't worry, put everything under goodwill, because goodwill will take care of all the intangible assets, because goodwill itself is an intangible asset, right? If you're not able to identify different softwares and revenue generating units, and hence you're not able to identify the intangible assets relating to different part of the business, then put on everything under goodwill. Because in order to have any intangible assets separately in the balance sheet, you need to first identify them, right? You can't call Mary, James, Ali, or Pawan to anyone without seeing the person, right? We are seeing what we are saying is very basic. If you can't identify the asset, intangible asset, and you can't identify them separately, you can't put on the balance sheet, can you? That will be fraud. You need to first identify the asset, intangible, even if it is, and then put a number on this. If you can't, then it is not distinctly identifiable, and plug all the numbers under goodwill. Now, where the price paid for the intangible can be distinguished from the goodwill and the future economic benefit arise can be identified, the test of identifiability is made. So this is what I said is called test of identifiability as per paragraph 34 of IS 38. If test of identifiability is made, then you have a separate asset and you can recognize an intangible asset as well, such as license or software or vaccines, etc. Goodwill, another intangible separate asset that goes, as we discussed earlier, under the test of impairment. Normally, we are used to seeing an additional amount paid for goodwill. Like in my popular example, I paid 100 million and I had net assets of only 70 million, right? So 30 million is goodwill. But there could be a situation. Now, it could be quite frequent during, say, pandemic, or it was also quite frequent during 2007-8 meltdown. What was frequent? That you have an asset, say for 1 million USD, but you were asked to pay only 0.8 million because people don't have the money. They need to sell the asset to pay some other urgent requirements, and they are ready to sell it at any price. In this case, you are paying 0.8 million for an asset which worth 1 million. Here, there is a negative goodwill. And negative goodwill is not necessarily negative. Don't fall in the trap. Negative goodwill only means that you are getting a discount. So that means here you are getting a discount, and that is like a negative goodwill. You are paying less for the highly valued asset. What is the amount of goodwill? Negative goodwill, 0.2 million. Great news. How do you treat them? That is a credit in comprehensive income. That is like a income. Stop me anywhere you have a doubt or question. So when we have internally generated goodwill, let's quickly jump into those sections. How do we treat them? If we are generating goodwill internally, there is no choice. It just does not get recognized. You can have intangible assets internally generated, but you can't generate goodwill internally. Some may argue that what if I get the advertisement of my product and services and my brand by biggest celebrities and the movie makers, etc. Or maybe my science textbook is advertised by the world's biggest NASA scientist or the nuclear physicist. So what? There's no goodwill which can be generated internally. You can only acquire goodwill when you acquire a subsidiary or any other company. You cannot internally create this guy. Let me remove it from the screen. Hope it is clear. Next, I said intangible assets can be generated, but that is also not that easy, quite restrictive. So generally, we understand that intangible assets can be something like license or the patent, etc. But after all, what are they? They are R&D, isn't it? And there are different types of R&Ds. Pure, applied, and developmental. When you have pure and applied R&D, again, cross marks. They are not recognized in intangible assets. Hope you all are paying attention to this. This can come as a surprise to many. So any pure and applied research and development activities or intangible assets or investment, they are not considered as intangible assets. Only when it reaches the developmental stage. And that too, there are some terms and conditions applied. Okay, so research phase, no. Development phase, only if strict criteria are met. Let's move and see what are they. Development defined product, it could be product, process, systems, anything. I personally work on the development of various advanced accounting system, platform, investment application and platforms on regular basis. So when we are doing the brainstorming, we are doing a lot of research, talking to the engineers, scientists, artificial intelligence experts, and all the money that is spent on these activities, they are not recognized as intangible asset by the company. They are expensed out. When it is recognized, imagine, let me give you a scenario. Imagine that I and my team, we are working on building some fantastic platform. Okay. Let me add some cable. And it is powered by AI, artificial intelligence, and then there is some quantum computing as well. Hope you have heard of quantum computing. That's a much more powerful and dangerous than AI, artificial intelligence. So ultimately, we developed a system which can predict next burst. Okay. Or it can also tell next Google, which company will be like next Google. Okay. So this is the platform that we developed. So what it is? So first we were making the design and prototype. These two are pure research. Of course, we got salary for that. We got bonus. We got everything, research and development and whatever you can think of. But is that recognized as intangible asset? No. But it was, the step was still successful. I'm not saying we failed. It was supposed still successful. Why it's not writing? Got angry. Okay. So next we move on to applied research. Then we decided that, okay, you can predict everything in the future. Then how can we commercialize, earn revenue for our firm? Be it JP Morgan or Citibank, wherever I work, right? So we started to use this for stock trading or kind of various other investment banking to help our client. We did some testing and it was successful. Now we crossed the level of applied research. So applied research is also successful. Okay. Do we still get it recognized as intangible asset for our firm? No. Still not. Then what happens? When do we get it recognized? So after application, we made a memo sent to 100 of our clients, and we asked them whether they would like to buy such kind of software or the license or our services. All of them said yes. So we have a clearly identifiable market. I'm just giving you a scenario to understand and grasp the process rather than just the theory. So all of them said that, yeah, it is a fantastic software. I would like to buy this license, etc., and I'll pay you $1 million every year for such thing. So I have a clearly identifiable market, and the process, basically people are ready to pay. There's a revenue stream which can be envisaged. All things set. Now I made also a memo to my global leadership team saying, I need to develop this now. We need to enter the development phase, and we need to build this software. It might need $1 billion of expenditure. Okay. In this case, what do you think the question will come, or what we all in the organization will talk about? Can you make a list of questions? The list of questions that you might think of is what the standard is also asking. So we are now at a stage when we are writing the IS 38 standard. Okay. And what could be the questions asked by the leadership team, by the even clients, maybe by our own team? Everyone will ask, okay, Nidhish, so what is the technical feasibility? Is this feasible? I say, yes, I have done the testing. It's technically feasible. All my AI experts are saying that it can be programmed. Okay. Intention to complete and use or sell. Do you have intention to do that? Yes. There's no legal prohibition. Clients are also ready to buy. General future economic benefit. Oh yeah, of course. There are 100 clients who are ready to buy it or get the license for 1 million. So immediately we are going to get 100 million revenue every year, and then we can grow it, right? Then do we have any adequate resource? Do we have cash? Do we have capital? Do we have team? Do we have time? Do we have commitment? Do we have all these background and capacity and resources to make it happen? I said yes to everything. After this, I have entered into developmental phase. This is called developmental phase. After all the due diligence. And once I enter this, basically all the salary I am paid, and my team, my travel expense, expertise or payment made to scientists, every single thing is now capitalized. And it will become intangible assets. Is that clear now? How it goes on and on. So only when the commercial viability, revenue stream, business is identified, only when you have identified a clear market, you have a market share to show, only when you have all the capacity, technical expertise, finance, capital, people, team, management, everyone willing and committed also to do this. When everything is identified and properly documented, then only you are permitted to capitalize the expenses on the development of the software. Because so far you have just done the prototype, you have done the testing, everything looks nice and flourish. But the development phase means you have to develop enough number of software, or you have to do all the detailed algorithm and programming. You have to feed a lot of data. and implement it across different software within the firm or with the client. So all those efforts that is done, that is part of the developmental phase. And once you are in the development phase, after identifying all the previous steps, you can capitalize this software, this license as an intangible asset. And it is not only for the softwares. It could be for the vaccine. It could be for any such internal research which is done. The same is applicable. Any question? Or sounds too confusing? Another test.
I have a doubt.
Sure, tell me.
Yeah. What about AI software in phones like Siri, Google? Because continuous research and development goes on them also, right? So how do they get accounted for?
How do they get accounted? So let me ask question to Clive to give the answer as well. When almost every firm, all the large multinationals are working on the AI, but I would say 90% of them are not recognized as intangible assets, because don't you see that almost more than 50% of them are still in the discussion and design design mode, or something that we claim that okay, it is artificial intelligence enabled product, still they are doing very basic functions. They are not really AI tools, like various bots that you see the popping up on the screen. Many firms claim it is AI. It is not really. They are just simple algorithm which has 1000 questions already fed, and they are responding based on the question and SQL, but it is not AI. A. B, so long as it is still in the research and development, they are trying to make it better or improvised, it is not recognized as an intangible asset. So what happens? They are all expensed out. So all such initiative, the research and development, they are considered as an expense of the firm. So any salary which is paid and the bonus which is paid to the R&D team, they are expensed out in the year they are incurred, unless they meet all the criteria which I discussed earlier. Of course, there are some tools which IBM has developed, IBM's Watson, and even Elon Musk, some of the effort which is kind of seeing some commercial use. Once you start to see the commercial use and application, once you are in the stage of development, then they are recognized as intangible asset. And any dollar that you spend, you can capitalize rather than expensing.
But on this, in research also goes place. For example, Apple Siri. On the older devices, they have been already launched, but on newer software, a newer version of Siri comes up. So that means continuous research is also going on the side, right?
Correct. So the research is not, that's what I'm saying. So the research are of two types. And most of the research, 80-90% of the research are of two types: pure and applied. Pure and applied research is never recognized as intangible assets. And why Apple? Many firms, even banks, continuously they are spending money on research. But unless they cross the two hurdles called pure and applied research, and they have documented all other steps for the developmental phase, only then they are entitled to capitalize those money. Otherwise, they need to be expensed, and they are expensed. Recently, I was seeing there was a lecture of Mihir Desai, the Harvard professor of finance. He was giving a lecture on the cash flow, operating profit, inventory level of three firms: Netflix, Tesla, and one more, Netflix, Tesla, and Amazon. So three companies he was comparing the cash flow, everything. And from the pattern, you can Google and see the pattern also interesting, that despite the fact that Netflix do not have their inventory like a traditional way, still their cash flow is quite negative, right? Amount of inventory or amount of asset that they have is also not great as compared to Tesla, despite the fact that Tesla's many projects are a failure. Because what happens sometimes, you invest a lot on the R&D and the research and development, but you're not able to recognize that as an internal asset. Unless you see a great market, you establish the cash flow, economic benefit from that research in the future, they are not capable of recognized as asset. In that regard, IFRS is quite strict. So activities that are neither research or development. So far we are talking about R&D, and within R&D there are 3 levels: pure, applied, and development. But there are some other type of cost and expenses which are not even R&D, like engineering follow through in an early phase of commercial production, quality control testing, troubleshooting, maintenance, or any analysis of the root cause of the issues. You hear frequently Sony and many such corporations, or that even Dell, they keep recalling their products, and they need to do the troubleshooting, root cause analysis, quality check quite in detail. All these expenses are also expensed, despite the fact that it will require a lot of scientists, engineers to spend their time in the analysis. Still, they are all expensed because they are not working towards development or building one unique product. It is still a business as usual, BAU activity for the organization. Hence, it doesn't matter who is working in that. Even though some top-notch scientists from the computer engineering side are working to troubleshoot some of the quality issue, still it is not recognized as intangible asset. Tough world of IFRS in this regard. An asset is identifiable if it is separable, that we have discussed earlier, that it has to be distinctly and uniquely identified from all other assets. And then future economic benefit should also be established coming from that unique product. But an enterprise may be able to identify as an asset in some other way. For example, an intangible asset is acquired with a group of assets. The transaction may involve the transfer of legal rights that enable an enterprise to identify the intangible asset. So what it's saying is that A has acquired 50 assets from B. Generally, from the business perspective, A is not able to identify all the different 50 assets. But in case there is any market to legally transfer one or two of the asset or its license to another party called C, if you can legally transfer the rights of use to another party called C by way of some agreement, then that instrument or that product becomes separately identifiable. So also try to assess whether the title or the legal rights can be transferred to another party. If the answer is yes, then it is also the asset is identifiable and distinct. Criteria for recognition. So here we made a decision tree because so far, even within 17 page, we have come across so many different rules. So how to make it simple? Is the asset intangible? If the answer is yes, can we identify it separately, just like we discussed earlier in last few pages? Because if it cannot be identified separately, then it will be either part of the goodwill or it will be expensed out. next question, can we control this? I think we need to spend some time on this. Controllability. You might have great intangible resource, or it can be identifiable separately, but you don't have the control over this, right? Suppose a parent company acquired a subsidiary and 10% of the investment is also by some other company, maybe competitor. For some reason, competitor still influences this product a lot, and the parent company is not appropriately able to use this software, this license, because the competitor, which also has 10% stake in the company, they are somehow able to influence the use of the software, and because of that, the parent company is not able to properly use this software. Now the question comes that who is controlling this? It is not the parent, it is the other side, and another company which is controlling. So if you don't have the control on the asset or any intangible, then it cannot be recognized as asset. So controllability is key factor. If it is still yes, answer is yes, then the question comes, third step, is it capable of generating future economic benefit? Of course, we can't ignore this. There's no, I mean, the definition of the asset is basically the ability to generate future economic benefit. If it cannot generate the future economic benefit, no point keeping it on the balance sheet or boast about this. It is not an asset anyway. So another critical criteria, third step. Then fourth question, probable future benefit will be generated. Will we be able to realize the probable future economic benefit? And if yes, can we measure the cost? Otherwise, what will we show as carrying amount? If we can't measure the cost, how will we arrive at this number? So costs need to be reliably measured. Only then we can recognize. So a long route to get recognized. Otherwise, same word, not recognized. So this is the decision tree for the recognition of intangible assets. Just flipping through some other critical point that we need to discuss before moving to another standard. Accounting treatment of goodwill. Amortization prohibited, annual impairment review. Inherent goodwill not normally recognized because we don't recognize any internal goodwill. When the amount paid for the assets purchase is less than the fair value, then there is a credit income. We have talked about this. Let's see a summary of all these points in one place. There are some other, let me stop here. So in case of the computer software, the rules are little liberal, okay? IFRS is little happier with computer software. And not to forget, there is a massive industry groups which also work behind the setting of the standards. They try to make themselves heard. They try to explain their situation and the industry requirement. And sometimes then standard setting committee also consider their argument and make a way specific for that industry. Hence, in this regard, computer software has got some good points heard, and they have little more flexibility. So if a software is created internally, first of all, if it is for the specific customer, suppose TCS, Infosys, Google, Facebook, or any such company has got the tender and request from the client that can you make one software for us which can maybe tell us all the great software, great stock in the future. So maybe Google made one, In this case, customer specific order, it is expensed. Internal use for external use, when the firm created for its own business, okay, in order to give the license or to do the trading in-house, then cost of design, coding, testing, documentation, training material, etc. are capitalized. Note this one, quite important. Cost of design, coding, testing, documentation, training materials, etc. are capitalized as intangible assets. And what it is for? Computer softwares. Don't apply this argument for other industries, though. And I do understand that if it is applicable for computer software, it should be for other industries as well. And I don't disagree with you. But for computer software industry, there are much more flexibility, as you can see here.
Sir, but as you know that artificial intelligence AI would take over all these softwares and all, right?
Yes, yes.
Sorry, can you please continue? Sorry, can you please continue? So AI will take over all the softwares and
क्या बकवास लगा रखा है यार, बकवास कहीं के। इससे अच्छा मेरा आईफोन है। Hello, we are from Zoom India support team.
sorry.
We are from Zoom India support team.
Okay.
Wait, make me host.
For what for?
For security reasons, make me host.
So cost of design, coding, testing, documentation, training material, etc.
Hello. This meeting is hacked, so you remain your privacy.
Anyway, let me see who's chatting. So someone was talking about the artificial intelligence one. So let me just clarify. So yeah, the argument could be that we need to treat AI and many such advanced technologies separately in a different way. So my take is that your argument is valid and such software industries and businesses need a different treatment, but it will take some time. We are in the era of even AI ethics and various such things needs to be built. There are laws and legislation are required separately for AI. Nowadays, we are in a cyber world where most of the things are done in a virtual manner. But the rules, regulation, accounting standards, IFRS, and all these things are still based on maybe the business context or scenario 10 years ago, right? And in last 10 years, we have seen so many different changes. And accounting, law, business, taxation, everything needs to catch up. So definitely, be it any accounting standard or the Companies Act or the rules, they are not true reflection of what should be happening. Okay, so let me go back to our great slide. I just wanted to make a point for the computer software industry, and we can move. This question. So good fab lab work on its production process that is all right. I think Dr. Priya account was being misused, so I have removed. I'm sure it is not her, somebody else. Anyway, so Good Fab Limited work on its production process that is going to revolutionize the fabrication of the product. The development cost €750 in cost during 2007. For 1st December 2007 and 31st December 2007 as well. The corporation can prove that all criteria to account for an internally generated intangible assets are met since 1st of December 2000. Sorry, should be 7. All right. So once the criteria is met, from that point onward, basically, we can recognize any development expenditure. So the production process almost cost 750,000. 450,000 was spent in this duration, and remaining 300,000 pound is spent after the criteria is met. Therefore, only 300,000 will be recognized as intangible asset. So the next question comes back on brand accounting. Brand is very similar to Goodwill in terms of the treatment. So it includes in statement of financial position to preempt equity depletion caused by Goodwill write-off, typically not amortized, just like Goodwill or even a piece of land. These two things and such elements are not amortized because they are not considered like a tangible asset. Sorry, they are not considered like any depreciating asset. Generally, we don't amortize any piece of land because we consider that it will go up in the value. Similarly, Goodwill, unless and until there is a impairment indication, we don't consider any impairment, and brand is also not amortized. They are in fact considered for the impairment only. Major disclosure for internally generated. There's no guess what will be required. We need to have all the documentation for process adopted, the research R&D conducted, the market share, our capability to conduct further research, right, to complete testing, all such process that we have used to come at this level of development, to the level of recognizing the development expenses. We need to disclose that. How did we do that? What was the rationale behind this decision, why we should consider this as intangible asset. All the information should be also disclosed. So this is summary. It is an important one that you can quickly note. Identifiability evaluation. So what is identifiability? Separately distinguished. Evaluation, that we should be able to find out if this is successfully developed or it can be completed or not. So the business rationale should be defined. The respective costs are distinctly evaluated in order to be allocated. Costs to be allocated are determinable, and ability to measure the expenditure. So evaluation criteria should be strict, but it should focus on the cost, distinctly identifiable cost, plus ability to measure the expenditure. Technical feasibility, proof should exist for technical feasibility, right? That is the key. If we can't proceed with this AI research, we can continue doing the research, but we need to drop the idea of considering this as a intangible asset. Okay. Commercial success, do we have market, or are customer willing to pay? Future economic benefit, will we be able to capitalize on this? There are many great research done every year, but they don't yield any great future economic benefits. Many people even question Tesla's all the R&D and the achievements, thinking that are we really going on the moon or Mars or so on. So future economic benefits. Financial feasibility, how much money it will require? Do we have too high ambition that cannot be fulfilled given the capital? And then intention to complete. Are you just making the plan, or are you serious to complete this project? So all the 7 criteria should be made before we conclude the decision to capitalize the expenditure on development cost. But remember, pre-development, such as pure and applied research, they are not and ever considered for intangible asset. Only development cost and expenditure are considered for intangible assets. Okay, so I'm stopping the share and we'll be jumping into a new standard. In the interim, if you have any question, please let me know.
Does cryptocurrency fall under intangible asset?
Cryptocurrency. It depends on which perspective you are talking from. Say for example, I am the one who is mining, right? Cryptocurrency, and
Yes.
you are the one who is investing. So if you are the investor, it is not intangible, right? If
Okay.
I'm the developer, probably, or maybe the company that is mining, right? For me, it is also not intangible asset, because it is being bought and sold as an investment product. You know what I mean?
So current asset?
No, it is investment asset. It just like you have a piece of gold, right?
Okay.
It has its own value. So cryptocurrency is what? It is a virtual currency, right? Say 50 years down the line,
Bitcoin.
you may be 26 cent. I think you have been a great nuisance. So I'm removing you and probably reporting as well. All right. So now you get my point, right? In future, you may be paying cryptocurrency 20 years down the line. So it is no different from the gold coin or any USD bill that you might be using currently. So cryptocurrency is an investment. You can consider this like a currency, virtual currency. It is like an investment, right?
Okay.
of course, there are various controversy even now around that, despite the fact that every Bitcoin is $25,000 worth, but it is at its best form, it's an investment.
But it's internally generated, right? Using the software and hardware capabilities of whatever the company.
True, it is internally generated, but everything that is internally generated does not mean it will be intangible asset, right? For example, you see the PPT I have created, internally generated, right?
Yes.
Do you want to buy all my PPT for say $100? I'm not going to charge, just yes or no.
Okay. Yes.
Just like that. So I have generated something internally as a private limited company, and entire world is ready to buy. Then the value of that product is based on how much you are willing to pay. Fair value minus cost. Despite the fact it is internally generated, it is not intangible asset because now I have identified a market separately for this, and you are willing to pay for this PPT or any such product. So I would not consider this as an intangible asset. It has a distinctly identifiable market, just like any other product or license.
Okay.
Okay. So it is not at the development stage. It is not at the R&D stage. Now it is a Bitcoin is not at the R&D stage now. That's another way to look at this. Maybe 10 years earlier, it could have been on R&D stage and it could have been discussed whether it has an intangible asset or not. Now it has a clear-cut market, so the valuation will be done as the investment product rather than a license. That's the difference between intangible or any such product like vaccine. We can base the argument for vaccine, maybe corona vaccines, and many have crossed the developmental phase. So any expenditure which is being made on, I think, almost 10 different vaccine trials, they are at the developmental phase. They have completed various market requirements. They are commercially viable. They have the capital. They have expertise. So I think they can claim intangibility to be identified in the balance sheet separately. Right? So that can be more valid example.
Okay.
All right, so I'm going to open IFRS 15 now. We have a little kind of less time left, but I want to just walk you through quickly with some of the key criteria for IFRS 15. Here we go. PPT starts now. So let's go straight to the concept. Sorry, somebody wants to say something? All right, so why some people don't want to learn and study? All right, so the agreement you have with a company, suppose you are we are a company called Alpha Limited, okay? There's a company called Alpha Limited. They went to do a contract. Let me start with this example so that many points can be identified in one go, okay? They went into a contract with a software company called Info. Now the software company has promised to provide PC. Okay, one thing. How much for? 1 million. Some softwares, 2 million. $2 million for softwares. Maintenance, maybe 1 million. This is maintenance, okay. And consultancy, 5 million. So 1 million, 2 million, 1 million, right? So altogether, the bill is made for 5 plus 1, 2 plus 9. Total 9 million is the bill for. Now, let's jump into this core principle. IFRS 15 wants you to recognize the revenue in 5 steps. So Alpha Limited went to info company and asked for 4 or 5 different things. 1, PC, computers, 1 million. Software, 2 million. Are you with me? Maintenance, 1 million. Consultancy, 5 million. Okay. So altogether 9 million worth of service. You have to complete this in 12 months time. All of this. All right. So you had to identify the contract with a customer. That's the first step of IFRS. Did we do that? Yes. Here's my agreement and contract. Identify the performance obligation in the contract. Did we identify that? Can someone say yes or no?
Yes, there are differences, right? Consultancy, software, there are all different performance obligations.
Yes. So we have identified the 4 performance obligations, 4 different types of performance, and also the timing, actually. That is done?
Within 12 months.
Within 12 months.
Okay.
I wish I could add more complications, but just because of the limitation of the time, I want to just go through the high level stuff. Determine the transaction price. Did we identify the transaction price? Yes, I have identified the total, and I have also identified the sub prices, right, for each category of the service separately. So that is also done. Allocate the transaction price to the performance obligation. What were the performance obligation, Ajay? You said we have identified, right? Performance obligations are identified 1, 2, 3, 4. Okay, done. And the respective dollar value, 1 million, 2 million, 1 million, also identified. So the performance obligation and the respective transaction prices, both are identified. Do you agree? So as we have performance obligation, transaction price, everything identified, and it is allocated as well, step 4, then what we need to do? You have to just wait at the step 5. Why to wait? You have to just sit on the mailbox or make a telephone call to your stockist. Have you delivered the PC? Yes or no? Yes, then 1 million revenue recognized. Then talk to software team. Have they sent the software code or all the links to the client, which is Alpha Limited? Yes or no? Yes. 2 million also recognized. So 1 million recognized, 2 million recognized because PC was delivered. Software is also provided to the client. Okay. When it comes to maintenance, there is a slightly bad news. You know why there is a bad news for maintenance? The problem with maintenance is that you cannot, at the start of the process, identify any sort of maintenance because you have to wait for the entire 12 months, isn't it? So since you have to wait for entire 12 months for the revenue to recognize for the maintenance, you're not able to do anything in the first week or the first day of the agreement. maximum you can recognize PC softwares immediately after you deliver it to the client, but you have to wait for maintenance and consultancy for the entire year.
कृपया ध्यान दीजिए, जिस किसी को भी पागलपंती पसंद नहीं है ना, तो ये वीडियो को नहीं।
So in this case, basically we'll just stop recognizing let me remove someone before I share this screen again. All right, so Mr. Shubham Kumar is gone. There's a lot of party happening. Anyway, so back to our scenario. If we have delivered PC and software in the first week itself, then what happens? We have recognized all 1 + 2 million of revenue, which is done. Now the second part is, Collins, is it you?
No, not me. I'm quiet here.
All right, there was some paint appearing on the screen by mistake.
Oh, perhaps it's me. Sorry.
There are two Collins.
Oh,
sorry.
All right, that's fine. I know you are a very serious student. So, but I hope you're getting the point. So PC and software already delivered. Now the maintenance and consultancy, you have to deliver that in 12 months. And 4 million, actually 3 and 6 million is outstanding for these two services, which needs to be delivered in 12 months. In the first month itself, in January, you can nevertheless recognize 6 by 12, 500,000, because first month is lapsed and this much of revenue you can claim. So how much you can claim in the month of January? These two, 3 million and 0.5 million, 3.5 million you can claim in the first month itself. So that is the crux of IFRS 15 revenue recognition. And there are 5 steps that you need to conclude for IFRS 15. Identify contracts, then performance obligation, third is transaction price, fourth, for each performance obligation, identify the allocated price as well. So performance obligation to be linked to price. Did you see I had done that clearly at the start itself? And finally, final step, recognize revenue as service or product is delivered. Okay.
Sir, there are two students using the same name.
Oh, yeah, I'm not going to end. All right. Yeah, I'll just stop share, and I'll just maybe I'll do some analytics on that as well. Mohsin other. Any duplicate name will be removed. It's historically the most annoying members. But yeah, thanks for the rest of you. It has been very interactive and good discussion. So as we almost conclude the session on IFRS 15 as well, do you have any question or doubt? Maybe I can just quickly show you the rest of the pages. So I want to just before we depart, tell you a couple of other salient feature of this, that whenever, let me go to a blank page. Whenever in the IFRS, clear all drawings, 15, you have service agreement, look for the price for each obligation. That is where most of us gets trapped. Price for each obligation of performance obligation. Okay. Then analyze when and how you are going to be paid. Just because the agreement says that you will be paid in the first half or in first 6 months, it may not mean anything, because you have to really see whether you have fulfilled the performance obligation. The second trap also comes in some of the question is like this. Okay, I might say that I asked, I am Alpha Limited again. Okay, Alpha Limited. I asked my vendor Info Limited to supply me 100 PC. Each PC is priced at $100. Okay. Then I also have an agreement, kind of insurance. Okay. That agreement says that within 12 months, I might return all the pieces to you if it is faulty. Okay. Now, what can happen? One thing. Second thing, within 12 months, I might return all the pieces to you if it is faulty, right? General, the trend says at Info Limited that customer returns the PC at the rate of 5%. So only 5% chances the PCs are defective and it needs to be returned. So what does that mean? Your revenue, which was 100 times 100, 10,000, 5% of that might be bad. So 5% of the PCs are returned, and every PC when it is returned, it costs the firm called Info Limited say $50. Okay, so 5% of 100 PC, 5% of 100 times $50, right? How much? $250. That remains at risk for how many months? 12 months. Okay, are you with me? All right, I lost you. So first step is recognize the revenue if you deliver the product. That's okay. But sometimes there is a clawbacks, some insurance clause that is also sold by you, and you have sold that your client Alpha Limited can return the PC to you, and you have to provide the replacement. Generally, you see that it happens only 5% of the cases, and when it happens, it costs you $50. So you have to calculate the 5% of total PC, which is 5 computer times $50. that can be a likely cost for you in next 12 months, $250 that might come and bite back to you. So you need to deduct this amount from the total revenue of 10,000. So first, when you deliver all the 100 PC, how much would you recognize as the revenue? 10,000 minus 250. How much? 9,750 only. Okay.
I have a question.
Sorry? Yeah, please proceed.
Why can't we recognize 250 as a provision?
We can have this as a provision, but here the difference, IFRS 15 do not suggest the provision. This is IFRS suggested method that do not recognize the incumbent losses until the respective time expires. You know what I mean? So 250, which is pending, right? This is like a pending revenue. So pending revenue cannot be recognized because this you will earn only when the time passes through. So you can divide this in 12 months. So every month you can start to recognize this. So something like $22 or $21 you can recognize every month, because if people don't come back and say that okay, this was a faulty product, you can recognize this every month
as revenue, right? $21
as a revenue. Yeah, because remember initially you had only recognized 9,750, and now gradually as the time proceeds you can start to recognize additional revenue if no one comes back with the claim. But if they come back with the claim, then you know what to do. You have to start recognizing the 50 and 5 basically as a loss. Okay, so the point I'm trying to make is you need to apply some probability. What is 5% here? This is probability. You need to also recognize that not all the money which is as per the agreement is something that you can recognize straight away. You have to wait for some time depending on the clauses of the agreement. So apply probability, apply the clauses, wait for the complete time to expire, look at the complete duration of the contract, right? Just like we did for maintenance and consultancy part of the agreement. So all those factors has to be considered in depth before we say that, okay, revenue is mine. The organization can recognize the revenue. It is a little more complicated. And each and every clause has to be examined. Maybe in future session someday we can have a much deeper discussion on IFRS 15. It is a very useful and applicable and relevant standard as well. But this is kind of most of the useful provisions of IFRS 15 that we have covered. So if you got it this one, you have pretty much good idea.
Am I audible, sir? Am I audible?
Yes, you are. Yeah. You can speak now. All right, till then, anybody else has any question? So I can't hear you. You can type your question if you wish. Can you all hear me?
Yes, we can hear
Yes,
you.
I can. Yeah.
Okay, perfect. All right. So the question is from Muhammad, that is IFRS suggesting any probability estimate? Yes. Ritik Desai. So the answer is yes. IFRS 15 suggests quantification on the basis of probability as well. So what it says is how to apply the probability. if I have sold 100 PC again, and there's a chance of 5% being returned completely. Okay, there is no warranty or insurance issue. It can be just returned back to me within 12 months. Okay, and each return again cost me maybe $20. I have to apply the probability, and IFRS 15 allows us to apply any probability statistical method, because these are the methods and tools which tells us what is the probable outcomes of the revenue, what is the probability of the business to proceed, right? So, and another thing is IFRS also allows us to use any tool, right? Any tool or technique which gives, someone helps me, which gives true and fair view, right? So we can apply standard deviation. Many of you might be knowing already where, right? Sensitivity analysis. Many such tools are permitted under IFRS framework when it comes to providing true and fair view, the substance over form. The economic reality is much more important than the rules. IFRS even allows you, let me tell that one, an important aspect. If you decide to go beyond IFRS 15, you don't want to apply certain rules and provisions of IFRS 15 or any such IFRS, you can do so. IFRS in that regard is very flexible and very sensible. It tells you can use any other method, or you may choose not to follow the suggested practice under IFRS, but you need to explain why you are doing so. A. And second, you also need to tell that how your methodology, your techniques, or your approach will provide a better true and fair view. If you can explain that one, you are free to use any other methods which can provide better true and fair and more substance of the transactions, better view of the transactions. Hence, IFRS is very flexible to accommodate such methodology as well. Make sense, Mohammed? Let me see if any other question. All right, so I think we are good for now. And if you have any other question, you can you can catch me on Facebook, or you can send also an email to me. Here's the email ID. Let me just get rid of my handwriting. Nidhish @finsapient.com. I also post the videos on FinSapient channel on YouTube. Also, we have IFRS Global Forum. So you can post your question, and it will be a good way to discuss, and everyone can contribute to the questions and answers as well. So let's make it an ongoing journey, and whatever paper you are preparing for, or maybe you are preparing for your upskilling at work, best of luck and best wishes with that. And in case of any question, you can send me the email or catch up on any of the social media platform. All right, great. Thank you so much for the time and question answers, interactions. And of course, sorry on behalf of some of the folks who created nuisance and wasted some of our time, but those things happen. Life. All right. Best of luck, everyone. See you later.
Thank you.
Thank you all. Take care.